I'm the founder of an organisation called the Complexity Board. Before that, I co-founded an organisation called CodeLab 4. And before that, I was the head of innovation across NAB's business bank. And I've spent about 20 years within corporate finance in the telco media sector and the emerging digital sectors. And I was also the head of the government education and community business at NAB for a number of years. The point I used to always say about innovation is that it's got absolutely nothing to do with the blockchain, AI, or technology. And it's all about mindset, cognitive diversity, problem solving. And the most important thing is embracing uncertainty. This to me is the most important statement in the entire pack that I'll be presenting today about our modern day global financial system and how we see reality. I think it's a conversation we don't have enough as a community. The nature of reality is made up of three things. The first thing is complexity. You know, the world we inhabit is far more complex than any of us have the capacity to understand. And the more that we sort of unpeel this onion, the more that we are amazed by just the sheer complexity. You know, if you look at microbiology and some of those areas, what's becoming apparent very quickly is that, you know, traditional cell-style structures aren't simple at all. They're highly complex. So this sort of notion of simplicity is the antithesis of reality. Out of that complexity also comes the notion of uncertainty, because in complex systems, the notion that cause and effect, logic, reductionism, they're tools, they're heuristics, but they don't actually have the capacity to, for us to sort of make sense of that world. And the third issue that comes out of that is human fallibility, that time and time again in our attempt to navigate reality, we fail. And that's okay because we're human. And, you know, that's just the nature of the complexity that we're facing into. So if we start with that sort of premise, we end up in a fundamentally different space. The way that we think about the environment, the way that we think about our financial system, the way that we think about, you know, this notion of predicting the future starts falling out. You know, it's a myth, it's a sophism, and it's a fundamentally different way of dealing with reality. What I've also realised, and my undergraduate degrees in commerce and accounting, and I've done all the business school stuff and so forth, but what I realised is the limits of logic. And in this world, we actually need three sets of skills. We need to understand heuristics and logic and reductionism and abstraction, but we also need to understand narratives and you know, our attempt to describe reality. And we also need to understand the transcontextual, our interdependencies with the complexity of reality. And particularly in the narratives and the heuristics, in the transcontextual sense, we don't actually teach our students those disciplines. You know, we hear all the time that everyone needs to embrace STEM, but we don't actually, we discount the arts, and we don't even teach our students anything about the nature of complexity. So there's a whole new field of education that needs to emerge around those three dimensions of navigating reality. The great breakthrough in finance, because up until the 16th century, we looked at the world, we tried to sort of articulate what the world was about, but we couldn't actually put a metric around the nature of uncertainty. And what happened in the 16th century was there was a whole bunch of mathematicians sitting in Florence, observing boats going from Europe to the Middle East and to Asia, the spice trade. And over time, they started building these statistical models. And they started coming up with probabilities of those boats returning, both the passengers, but also the boat itself, and also the goods on the boat. And out of that came the modern financial system. And the breakthrough was that we started quantifying the unknown. We started putting a number on that unknown. Now, the core issue with that sort of concept is the map is not the territory. It's a model of the world, it's not the world. And yet what we've sort of done over the next 200 to 300 years is we've taken this sort of very literal approach, and we build these incredible models, you know, value at risk models or capital asset pricing models, Black-Scholes option pricing models. And we get really sort of excited by that scientific precision. It gives us this sort of warm and fuzzy feeling, but the reality is that they're models of the world. There's a gentleman, George Box, he's got a famous saying, all models are wrong, but some are useful. And it's having that sort of nuance to be able to navigate and have that humility to navigate the limits of logic and the limits of science that's critical. That's just a bloke from the spice trade times. So what we did in economics was that we came up with the first attempt at economics, real attempt at economics, was this notion of classical economics, where, you know, the economy works, and then every so often it doesn't. You know, we have some sort of financial crisis and so forth. And what we did then was that we had monetary policy, and we had the capacity to move interest rates around, and the price of money, it was all linked back to gold back then. And that was the way in which we could sort of kickstart the economy. But what became apparent in the 1930s through John Maynard Keynes was that there were some times when even if we reduced interest rates, the economy wouldn't kickstart again. And it wasn't just about the price of money or the price of goods, it was also about the income or the wealth effect. So he came up with this sort of concept of Keynesian economics. And when we start combining Keynesian economics with classical economics, we come up with this concept of neoclassical economics. Now, the problem with that idea is that sort of has at its heart a very sort of industrial age way of looking at the world. You know, we look at the world as a Swiss clock, and we sort of move this lever and this lever, and if things slow down, we use monetary policy, and if that doesn't work, we use fiscal policy. We're seeing it this week actually in Hong Kong, where the Chinese government's actually giving every citizen $10,000 to sort of get through this slowdown because of the coronavirus and some of the other issues happening in Hong Kong at the moment. Now, that's a classic Keynesian response. Just hand them some money. Then what happened, we had this thing called Bretton Woods, and the US at the time had all these huge gold reserves, and it sort of managed to negotiate a deal with the rest of the world that you could either have gold reserves or you could have US dollars. But then in 1971, the US President Nixon decided that the US dollar doesn't need to be linked back to gold. It's a fiat currency, you know, it's a strong nation, we'll do what we want to do. And out of that, you actually had the true birth of fiat currencies. There's been other times in history, but what I mean by fiat currency is the currency itself is not linked to some sort of underlying asset. It's basically just a piece of paper, and that in itself. So it's all based off this notion of trust. And if we don't have sort of trust in that currency, the whole system starts collapsing. And with the sort of move to fiat currency, that's when all the problems have really started. So we've had this incredible series of financial crises since then. There seems to be one every couple of years, but apparently these black swan events only happen once every couple of thousand years, but they happen every couple of years in this new world. And a lot of this is caused by the models of reality that we've sort of created. And that, you know, these models, and I call it ideology. And the problem with any ideology is that you look at the world, you observe the world, you've got a model of the world, but when the world doesn't reflect your perception of the world, you're simply not willing to update your models of the world. And we need to sort of build a society where we almost have like an OODA loop. That we've got a model of the world, we think that's the model of the world, but when we observe something new, we update our models with some new software. And it's this constant update that will give us the capacity to navigate reality. And that requires us to be open to divergent views. I mean, that's another issue that we have in our societies, that we've got social media, we've got the polarization of views, the left absolutely adamant they're right. The right's absolutely adamant they're right. There's no conversation. And I would actually argue we need to move from a Aristotle view of reality, which is all about logic, to one of a Hegelian way of looking at reality, which is a debate of ideas, and a humility that we're just trying to sort of work this out as we go along. And that's a fundamentally different society. But that's the only way that we'll actually navigate this, this new world. So out of that, we had a series of financial crises. The one on the left-hand side is the 1987 crisis. The one on the right-hand side is the GFC in 2008. There was also a dot-com crash as well. I've ignored that. And there was a whole range of currency and sovereign crises around the world. Something profound happened in 2008, which has actually made the situation far, far worse. Now, during 2008, there was clearly too much excess in the global banking system, and there was this sort of debate around how do we solve this issue? And the debate comes down to two things. Is it solvency or is it liquidity? And the powers that be decided it was liquidity. There was a couple of people that said it was actually a solvency crisis. There's a lady by the name of Professor Anna Schwartz, who was a leading monetarist out of the US, and she was adamant that it was about just banks and financial institutions having books full of bad assets that were never going to be repaid. Yet through the system, what they decided to do was throw more and more money at the problem. So we've had over $20 trillion worth of QE since then, and interest rates have gone to zero and negative. Now, what happens in that situation is that the value of assets goes to infinity. You know, they go through the roof. Companies are doing major share buybacks. People are taking on more and more debt. Houses become this certain way to make value. You know, the house in Sydney will always increase. It's just the way it works. But it's an illusion. It's a perception. It's a story that we've told based off central banks playing around with their models of reality. And the fundamental problem I have with that sort of narrative is that you can change your models of reality all day long, but reality is reality. And the perfect example of that right now is the coronavirus. Who expected the coronavirus? You know, you've got a whole bunch of large organisations taking on huge amounts of debt, assuming they're infrastructure style assets with certain returns that can pay dividends to their shareholders year on year. And now all of a sudden their financial forecasts aren't looking as certain as they were. And this to me is the fundamental issue, is this disconnect between reality and our perception of reality. And if I was to bet on this, it's a bit like betting against the gods. Reality will always win. You can't defeat the gods. Yet we're in this sort of illusion. And the only way that we solve for this illusion is one of two ways. We either have a debt deflation through a correction in asset prices, or we keep on throwing liquidity at the system and we have hyperinflation or serious inflation. In both cases, the value of money, this fiat money, is completely debased. I literally just went on the web yesterday, typed in assets, and you know this article's from the 26th. So every day there's an article like this that you can find on the web that talks about these things. It just doesn't seem to get captured for whatever reason in our mainstream press, or our universities, or in our leadership in a whole bunch of areas. So what is a well-functioning monetary system? Well, according to the BIS, the Bank of International Settlements, it requires, they acknowledge that the monetary system is the cornerstone of the economy. It's based off trust. It's based off a stable and robust institutions. And they argue it requires price and financial stability. I would actually argue something different. And I'll just go back to this. It's not actually in this version, but What I would say is that what we want is a system that's anti-fragile. We don't want a fragile system, we actually want a resilient system. And that to me is a bit different to having price and financial stability. Because I would actually argue the more that we seek certainty and stability, the more that we're building up future uncertainty and instability. I won't go through these, but there's a whole range of issues that are fundamentally wrong around how we see our economy and our financial system, and we don't have a public debate on any of these topics. We don't have a debate on how money's created by the major commercial banks. We don't have a debate around what the implications are of central banks playing around with interest rates. We don't have a debate around the bail prudential standards for banks globally. Yet we do need to have that conversation if we want to sort of move forward. What are the implications? Well, the implications are profound in so many ways. The first one is the complete mispricing of risk, interest rates, credit, liquidity, duration, higher and higher private sector debt, the financialisation of the economy, share buybacks, banks lending more money to people taking out buying homes and so forth. Increasing social inequality. So asset owners will win in this world, but those people that are asset light, they might have reasonable levels of income, will be the losers, because the impact of lower and lower rates actually eats into your savings and ultimately leads to high costs as well. We have stagnant real wages. We have higher non-discretionary consumer costs. So a really good example of that is health costs at the moment are going through the roof. Why? Because the whole insurance industry model gets subsidised by their investment returns. And as the rate of interest goes to zero, their investment returns decline. And as a result, they have to lift up their insurance premiums. We're actually seeing a mass exit right at this moment from our health insurance sector, but we don't talk about the impact of central bank interest rate policy on that. We say that it's a demographic shift in their view of health insurance. And I'm sure that is part of the reason, but I think it's far more profound than that. We also have low levels of innovation because it's more about rent-seeking sort of forms of capitalism than innovation. And we also have a focus on financial engineering. So there's a whole range of externalities that are actually sort of tearing apart the social contract. And unless we're courageous enough to have a public conversation on some of these things, we won't be able to sort of move forward. So what do we need to do? Well, I would actually argue we need far more economists that focus on the qualitative versus the quantitative. What does it mean to have a vibrant society? Is it all about GDP growth, or is there a whole bunch of areas that are qualitative around the style of life that we have that can't be measured in a spreadsheet? At the moment, with the increase in the digital economy, the relevance of the quantitative, the focus on GDP is becoming less and less relevant. We also need far more cognitive diversity in economics and across every sector. And I love what UTS is doing with their transdisciplinary approach in terms of getting people from diverse backgrounds together to solve complex issues. We also need to recognise the complexity and uncertainty of reality. This sort of Buddha loop way of looking at the world. Observe, orient, decide, action. This constant feedback loop to try to make sense of reality. And the last thing we need to do is we need to sort of embrace innovation and problem solving, the adjacent possible. Because I would actually argue it's through human creativity, problem solving and ideas that really drives the economy. It's not through this sort of Swiss clock view of reality. And we also need to be extremely comfortable with complexity, which is just the prevailing state of reality.